Hello and welcome to those of you joining us just a few minutes early for this session. This will begin on time at 11:55 a.m. Eastern Time. My name is Charlotte. I'll be your Money Show host for this session. Now, this one will be a recorded session from our March virtual expo for those who may have missed it. The rest of the sessions in today's expo will be streamed live. With that said, once again, to anyone just coming in, we'll be getting started on time in just a few minutes here at 11:55 a.m. Eastern Time. Thank you for your patience. Hope you're enjoying the show so far. And if you're looking for something to do while you wait, please feel free to scroll on down to Nitya Capital's virtual booth below the video player, check out their handouts, and of course, reach out to their team if you'd like some more information. Hello and welcome to those of you just joining us. We are still a bit early, just a couple of minutes to go before the next session begins on time at 11:55 a.m. Eastern Time. Thanks all for joining us. And if you're looking for something to do while you wait, please feel free to scroll on down to Nitya Capital's virtual booth below the video player. We do still have some handouts available there, and you can reach out for more information if you would like. Hello, everyone, and welcome to the session. It is my pleasure to introduce Swapnil Agarwal, who founded Nitya Capital in 2013, establishing a US-based real estate investment platform focused on multifamily and workforce housing across high-growth Sunbelt markets. Now, to our live viewers, please share any questions or comments you may have throughout the session in the live chat box. It's to the right on the right-hand side of the video player there. Time permitting, we'll see if we can get to some of those at the end of the session. And with that all said, Swapnil, I will hand the mic on over to you. I'll be here if you need me, but the floor is all yours.
Great. Thank you so much. Good morning, everyone. It's a pleasure being here and presenting the latest investment opportunity with you guys. So my name is Swapnil Agarwal. I was born and raised in India, moved to the US in the late 90s, went to college here in University of Texas. After working in corporate America for 10 years, I started Nitya Capital in 2013 with the basic premise of investing in workforce housing, multifamily assets, and to create a vertically integrated platform that not only acquires properties, but is also responsible for adding value and manage these assets and create investor returns after at the exit. To summarize our track record for the last 12 years, we have been one of the most active real estate multifamily investment platform in the country. We have acquired over 135 assets, totaling about 70,000 plus doors, uh, for a total value in excess of 8 billion. Out of the 135 assets we've acquired, I'm proud to say that, we have uh, a perfect track record. So we're 85-0. We have, never lost money on a single exit, on a single asset. On the 85 exits that we have generated, we have generated an average of 22% return a year, or 22% IRR, or a 1.6 times equity multiple on those exits. Uh, our platform today consists of approximately 50 assets, which is about 15,000 doors. Most of these properties are located in the high growth Sunbelt markets, such as Texas, Florida, Arizona, Nevada, Indianapolis, Kansas, Utah. So all the top states where there's a large amount of employment growth, job growth, and population growth. The platform that we run today is, like I described, is a vertically integrated platform that includes Nitya Capital, which is a GP and a general partner that raises capital and acquires assets. And also separately, we also manage our assets through our own in-house property management company called KPM Multifamily. And we also do our own renovations and rehabs, which then allows us to manage these assets and generate value for our investors without relying on any outside third parties. Now, amongst this track record, I would say that one of the most key track record, or the stat, is that we have never defaulted or lost money on a single asset in our entire history. There's not a single investor or a single loan that we've defaulted on. And because of this track record, because of this sophisticated way of managing these assets, we are now in the prime front row seat to get access to new acquisition opportunities. Now, for those of you who are not too familiar with the real estate sector, I'll maybe spend a couple of minutes describing what's going on in real estate sector. So, if over the last, I would say, 3 years plus, uh, the real estate sector has been hit because of the high interest rates that the Federal Reserve had to increase post COVID, given the rapid rise in the inflation. And when the interest rates go up, it materially and directly impacts the real estate asset value that one is holding, especially for a rental income property. So the market we're in right now, there is tons of distressed and foreclosed real estate assets that are in the market. Given our track record, given our performance, we are actually have a front row seat to acquire a lot of these assets that are being, foreclosed upon by these same lenders to the other borrowers who couldn't pay and who couldn't keep up with their mortgages. A lot of the same lenders that are now giving us these opportunities to acquire these assets. They see a great amount of performance and our ability to perform even when the whole market hasn't performed. And the three assets or the three acquisition opportunities that I'm going to present to you guys today is a direct result of those similar sourcing mechanisms. So first, I will want to go and highlight Project AC. So Project AC is an acquisition of two assets, one in Austin and one in Atlanta. Both are Class A and A minus assets located at an amazing locations in Austin. The asset called Copper Mill is located in the Domain, and in Atlanta, the property is located in Conveyors, which is again a very strong market when it comes to multifamily. So these two assets we're acquiring in distress, where the old lender, which is Starwood, has already foreclosed these assets from the previous borrowers. And now we are acquiring these assets at basically the loan value. So to give you guys a sense of these assets, these two assets were total paying $77 million. The last time these deals were capitalized in 2021, the original capitalization of these two assets was over 120 million. So we're acquiring these two assets where the original equity in excess of 50 million has been wiped out. And hence our basis is basically the loan balance or the loan basis that these deals existed with. And to make these deals even more attractive, not only we're acquiring these properties at the discounted loan basis directly from the lenders, that same lender is again providing us financing back on these assets at a better than market rate and a much attractive, I would say, terms compared to what exists. So we're acquiring these assets on an average of 6.5% cap rate, which is again a very healthy going in unlevered yield. And while we're buying these at 6.5 cap rate, our average cost of borrowing is approximately 3.5%, which means that in place day one, we will be able to generate 12 to 14% cash on cash for the limited partners and the investors in these assets. Uh, the per unit basis of these two assets, again, is very attractive. To give you a sense of the pricing, we're acquiring Copper Mill, which is the asset in Austin, at 115,000 a door. To give you comparison, these assets uh, in Austin were trading at over 200,000 a door. And the reason we know this is because we had several assets in the same submarket, which we sold in 21 and 22 at over 200,000 a door. So we're essentially buying these assets at almost half the price of what they were trading for 3 to 4 years ago. Same thing on Village at Village at Almond Creek. That asset is a Class A 2010 built asset in Atlanta. We're acquiring that at, I think, 165 a door, which is, at least 30% cheaper than what the replacement value is for that asset at a similar location. So the key highlights and the attractive points of these assets are a going in basis is extremely cheap. We're getting a very attractive seller financing back from the same lenders. And based on these bases and based on the capital structure that we've lined up, we expect to generate 12 to 14% cash on cash year one and average that for the whole duration of 5 years. And we underwriting the exit generating at least a 2.8 to 3x multiple on the original equity invested. The third asset that I want to describe and go over is a project called Project Tides at McDowell. Again, this is an asset that was foreclosed upon or is in distress with the previous sponsor. given a relationship and a track record in the industry, we have sourced this acquisition opportunity directly from the lender at the old loan basis. So we're acquiring this asset at $41 million. And the last capitalization, the last purchase price when this asset was traded for $65 million. So we're acquiring this asset at a substantially cheap basis. And again, we're receiving a very attractive seller financing back from the same lender at 4% interest rate. And this asset we're buying for 41 million generates $2.4 million of net operating income day one, which allows us to generate again 12 to 14% cash on cash day one. The distributions we expect to make on the quarterly basis, and I can say that, and we have confidence in delivering those returns again because in our entire history of 12 years we have averaged 10.7% cash on cash per year, and we have averaged 22% IRR on each of our exits. So again, to re-summarize, these two acquisition opportunities represent a very attractive acquisition opportunity because we're buying directly from the senior lenders who foreclosed on the previous borrowers. We're acquiring them at a very cheap basis, which is the loan basis. And then in return, we're also getting seller financing at 3 to 4% interest rate compared to the market where these assets will be trading at, compared to the market where the current debt you can get minimum 6%. Uh, so that's on the capital structure side and the purchase price of these assets. In terms of, the upside and the location, again, both the locations are super strong. They're located in again, the tier one markets, both Austin and Atlanta are tier one markets. And within those markets, a sub-market as well are very attractive as Austin one is located in Domain. In terms of the rent, both these assets, again, because there's been not a lot of attention and coverage given the distressed nature, there's still, both these assets have 88 and 90% occupancy. So again, a very, very solid occupancy, even without, getting a lot of attention. That gives and shows the strength of the submarket these assets are located in. In terms of the rent, we have we see a huge amount of upside on where the rents are, at least a 15 to 20% rent, which is lower than where the market is currently. And hence we have additional upside when we go in and implement our value add strategy. In both of these assets and any asset that we acquire, we obviously look for the right basis and the right pricing to buy this, but we're a value add player, so we look to go in and improve the condition of the asset and improve the cash flows of the asset. So we have set aside a meaningful amount of capex, which is reflected in the capital stack. So each of these three assets get about $3 to $4 million in capex, which the plan is to spend most of it on the interior upgrades. A typical interior upgrade for us costs anywhere from $4,000 to $6,000 to $7,000, where we replace the vinyl plank flooring, we put new appliances, new granite countertops. But essentially, what we're trying to do is to make these communities warm, hospitable, and really provide a clean and safe place for tenants to live in. A lot of other borrowers and buyers, they spend a lot of money upgrading the unnecessary things. For us, we focus on the essentials, and when it comes to essentials, it means interiors of the units, so they're nice and clean. And in terms of the amenities, each one of our properties has a gymnasium for the tenants, has a resident lounge, has a dog park, has covered parking, and we offer cable and internet package that is much cheaper than anyone else. So we focus on the essentials. We focus on our residents. We focus on providing a space that is clean, has the right appliances, it has the right reputation when it comes to for families that want to call this our properties home. So we spend a lot of time and effort in creating that community feeling And that includes as well, through our nonprofit arm called Karya Cares, to provide these residents with, free healthcare clinics, free swimming classes, free English classes, free access to immigration lawyers. So we try to bring in that community element so that, again, it's hard to quantify how that leads into the higher rent, but our average renewal percentage, whereas the market industry standard is 50%, our average renewal percentage across our assets is over 70%. So we tend to keep once the tenant or resident moves in, we tend to keep them for a longer period of time compared to any of other competitors. So that's the bit of description about these three assets. Our typical exit on a hold period is between 3 to 5 years. Again, every decision, every action that we take is in the interest of our limited partners. So if, while we're underwriting a 5-year hold, if the market turns and if the pricing normalizes, we might exit earlier. We may exit in year 2 versus year 5. It all just comes down to what the pricing is and what kind of returns we can generate. So while we're promising and underwriting a 5-year hold, I'm confident in our ability that within 3 years, we will be able to create and monetize these assets and create a very, very great outcome for our investors. Again, each of these assets and going forward, each of our acquisition opportunities are sourced directly through with the sellers or directly now in cases like today where we're buying directly from the lenders themselves. And that kind of shows you another aspect of these deals is, we're aligning directly with the lenders in the deal, which removes a lot of risk because, again, lenders providing us with seller financing, they're putting us in place, knowing our capability in improving the quality of these assets. So we have an inherent advantage as we go in and buy these assets. And again, to highlight the strength of our portfolio and the strength of our platform, again, each of our acquisition opportunities are sourced directly without involving any third-party brokers. So we're not getting involved or we're not wasting our time and bidding and bidding up the prices of these assets. And hence that gives us again an inherent advantage which is baked into the pricing that we are able to negotiate as we go and buy these assets. So beyond these two acquisition opportunities, I'm quite excited and confident that for the remainder of the year, we're going to see a lot more similar opportunities like this, where we will be buying at a fraction of the cost to what the replacement values are, and 30 to 50% discount on where the last capitalization occurred. So buying these properties and these assets at those bases gives us an inherent advantage day one when we look to exit these assets. Again, I will summarize the presentation today. So Nitya Capital, again, is an institutional grade multifamily owner operator that has acquired over 135 assets for over 70,000 total units since 2012. We have created exit and liquidity in 84 of those 135 assets and with an average IRR of 22%. Our current portfolio, again, is a very strong portfolio of about 15,000 units located all across the key Sunbelt markets. And another advantage we have is these three properties that we're buying. We either have an asset that we own in the same submarket today, which is the case with the Ties and McDowell deal. We have another asset that we own in McDowell submarket. And in Project AC in Austin, we used to own a lot of assets, which we've exited at great profits. So we're seeing, we have an inherent ability to compare the rents, compare the sales, compare the pricing to what exists to versus what we paid and what we encountered. These three assets, again, I would say represent probably the top three acquisition opportunities in the entire history because again the real estate market hasn't been like this since 2007. So after almost 20 years, we've seen a market which is conducive to making great deals, buying great assets, at a very, very good pricing. Again, it's been a pleasure and an honor to present to you guys, and I'm happy to take any questions from here on.
Thank you very much. We do have a couple of questions here. I'm going to start with this one from Mr. Castleman. He said he came in a few minutes late, so sorry if you've addressed this already. But he'd like to know: are these assets within one fund or invested separately?
Invested separately. So the two assets, which is Copper Mill and Almond Creek, they're part of one packet, which is Project AC. But in terms of the deal themselves, they're individual deals, so they're not cross collateralized, which is hugely advantageous because we can then sell even one asset and generate the return. So as an example, on Project AC, even if we were to sell one out of the two assets, which is, let's say, Austin or the Atlanta one, the way we are projecting, just the one deal itself will generate 50% profit on the overall investment for the investors. And the third project that is being done separately as an own project called Project Tides at McDowell. But to answer the question, none of these D3 deals are cross collateralized from loan perspective, and we have an ability to generate exit and create profits for returns for investors through sale of even one of the assets.
Thank you. Next up, I have Craig. He has a couple of questions here. The first one is: how many years is the lockup?
Uh, there's no lockup. So I guess if the audience is asking the lockup from the lender perspective, there's none. There's only a 12-month yield maintenance calculation with the lender. So which means we're still able to sell it within the year, but we just have to make them whole on the 1 years of interest payment. So there's no lockout for any of these investments.
All right, thank you. And the next question from Craig was just asking, is it true that the Austin rental rates have dropped?
Austin is a market which, as many of you might know, was one of the hottest markets in the country when it came from growing the rents in the city, 2014 to 2022. In 2022, Austin faced a lot of supply from 22, 23, 24. But the good news is that, again, there's no more supply coming in Austin. There was an article in Wall Street Journal actually last week which just talks about Austin and Phoenix being the top market going forward in the Sun Belt for multifamily. So again, Austin as a city, it has great fundamentals, it has great macroeconomics. There's a lot of job growth. And yes, the pricing has suffered, the rents had declined in the last 3 years, which is what makes this even more attractive because there's no more supply that's scheduled to come to Austin, and we expect the rental rates growth to be very, very strong going forward.
Thank you, Swapnil. And Craig is asking, he wants to clarify. He says the lockup period, he's asking about capital investment.
Yeah, there's no lockup for capital investment. Obviously, it's a real estate asset, so we do underwrite, a 3 to 5 year hold, but there's no lockup to say for investors.
Thank you so much. Now, it looks like we've caught up for now. I know we still have a few minutes left. So those in the audience, feel free to keep sharing your questions if they have them. And in the meantime, are there any frequently asked questions that you tend to receive? Or what about just information that you think, maybe I'd like to share this with the audience today, they could benefit from this?
No, I think we've covered a lot of the information, but again, in terms of frequently asked, look, I think from an investor's point of view, I would say that again, I would re-emphasize and re-say it that we've never had a project in our entire history where a single investor lost even a single penny. We have not lost any money in any of our assets. We've done this for 12 years. And the process from investors' point of view, again, is seamless. We have Juniper Square, we have a PPM and an operating agreement that every investor executes. And that template, hasn't changed. Every LP signs the same documents. And again, one important thing I would say is that as a sponsor and personally, we are always the largest investor in these assets and has been the case historically. So our alignment of interest is fully along with the investors as well. 10 to 20% of the investment comes directly from us, and the remaining is what we raise. So there's a full alignment of investors. We sign on the same documents as every other LP does. The investor's liability is limited to the investment they're making. As a sponsor, we sign on the loans, so it's our guarantee on all the loans. Investors are limited to the investment they're making. And again, a very seamless, smooth process, which we can obviously help guide the investors as they're interested.
Fantastic. Well, thank you so much, Swapnil. It's been a pleasure having you on. It looks like we've caught up with the questions in the chat. Now, to those of you watching us live, as I mentioned before the session began, please be sure to check out Nitya Capital's virtual booth. It's below the video player. It's also in our virtual hall. If you're looking for it later today, you can reach out to their team to request more information that way as well. Excuse me, I'm so sorry. It looks like we actually have one more question, if you'll have me.
Sure.
This is from Mr. Castleman. He's asking, can you accept qualified money for investment, such as self-directed 401k, etc.?
Yes, we do accept it. Yes.
All right, wonderful. Well, with that, once again, thank you very much. Again, to our viewers, be sure to check out that virtual booth, request more information from the team. Swapnil, thanks for joining us. Hope everyone has a wonderful rest of their day.
Thank you so much. Pleasure being on, and have a great day.
Yes, thank you. And be sure to stay tuned as everyone, as we do have more in store for you in this Money Show Virtual Expo. Thank you, everyone, for tuning in. To those of you who submitted questions in the chat box, I just want to give you a heads up. I did announce before we started the session, but this is a recorded session from our March Virtual Expo a couple weeks ago. If you would like to reach out to Swapnil and his team with the questions that you had submitted in the live chat, you can do so in their virtual booth below the video player and also in the virtual hall. Hope you all have a wonderful rest